All right, good afternoon, everyone. We have a fantastic session here for you, like all of ours are. It's going to be power packed in 40 minutes. What I'm going to show with you today is how to sell options using a technical based approach. Now, many people think, oh, don't ever trade short-term options, whether you're buying them or shorting them. And that's just a ridiculous general statement that it's misplaced because it's not put into context. So I've been trading options for over 30 years, and we have a technical based approach, meaning I start with a compelling pattern. So this is our approach at Master Trader. We start with a compelling pattern. It has room to move. I will decide then, do I want to sell options or buy options? I'll talk more about that. And then it's not just, okay, I have a breakout, I have a buy setup. We want to see where that picture is in connection with the trend, support and resistance, multiple time frames, what are the broader markets doing? And then everything is about position and money management. Without that, you're not going to succeed. And I say trader psychology in the context of once you have a systematic and objective approach to trading. Now, I buy and sell stock option ETFs, crypto ETFs, I trade futures, I trade anything that moves. But what I'm talking about today is just a one particular strategy. So one concept is not a strategy. We need all of these combined. And you'll see that every example that I share with you today in the allotted time, you're going to hear me talking about all the concepts of the technical setup before we get into the option strategy. So this is our approach of trading options in a very simplified manner. I need a high probability setup on multiple time frames, enter and manage per your trading plan, unemotionally, objectively, which is the trader psychology. It's using bar by bar analysis, pivots, vol contraction a little bit. So that's step one. Step two, a directional strategy to us means, look, I'm willing to buy or short the underlying stock or ETF because it's a beautiful setup and I want a big return for my swing bias. And we just use options, call and put options, and a combination thereof because of I say that there's three main benefits to them. And first of all, disclaimer, when you trade options, you always want to only trade liquid options. And unfortunately, I would say there's probably only 125 and less. I mean, you have your creating universe of like 25 to 30, the spiders, Qs, Apple, Facebook, some of these things are liquid as can be. Bank of America, AMD, NVIDIA, Cisco, develop your own. An income strategy, which is what we're going to be talking about the rest of the time here, is, look, I just want to take in the premium that the option market is offering me, and I can either sell a call or put naked or using a spread. We'll get into both of those because I want to keep the premium that I'm receiving. That all the stock has to do is bobble around and not go anywhere. And you'll see that it can even go against us and we still make money. So the odds are 2/3 in your favor when you're selling options versus buying them. That's kind of just a vanilla statement. Picking the proper strategies, managing in between, share side, and then once you're in the trade, using adjustment strategies. For the beginners out there, just definitions here. So buyers of call options, they have the right to buy the underlying at an agreed upon price on or before expiration. So it's a derivative. The value of that call option is going to go up in value as the underlying goes up in value. The opposite for buying a put. So these are directional trades like I just said, if I have a directional pattern, then I'm looking to buy calls and puts or combinations thereof. The seller, which is what we're going to be focusing on today, the seller of these naked or sellers of credit spreads, we are taking the other side of the option buyer's position based on our chart bias. So if I have a bullish view of a chart and I don't think it's going down within the days to expiration, I'm going to be looking to sell put options. If I think something is at a short-term high, a double top, for example, then I'm going to be looking to sell calls over resistance or what's called a bear call credit spread. So we're literally getting paid, and then we make money through time decay. We make money through, which is called theta in the Greek world. We're going to make money through the delta, which means as the stock moves in the intended direction, my unrealized gain is growing. And then as a seller, volatility is against you. So if volatility contracts, that's a third way to make money in selling these options. So yeah, I mean, some people don't even believe in charts, and they trade options saying chart reading is a coin flip. I said nobody can do it. Well, then why are we 80 to 85% successful over 30 years of trading and educating active traders and investors if that were an incorrect, if chart reading didn't work? And some of those same people say, you know, never sell a 0 DTE credit spread because, you know, I don't even know what the reason is. They're saying, I don't know, it's just bad information, and I'm gonna show you otherwise. We love selling options that expire 10 days or less, and that's what our weekly options trader does. That's all it does, is what I'm showing you in today's presentation, and the expiration is 10 days or less. So this is just a derivative of that. It's selling options 0 DTE that expire that day. So we only have a few hours of risk. And we're using our chart pattern. And whenever I'm comfortable saying, I think that's a short-term high or low for the day, I go through my checklist, make sure the options are liquid, see what I'm going to get paid to take on that risk, and put it on and manage it. Now, of course, higher the volatility, we're going to get higher premiums. So when the broader market is been selling off and I have a reversal bar on support and the volatility index has been rising, these are absolute field days. This is our best time to do it. But, you know, gapping stocks, new stocks, so we love doing this on stocks that announce earnings because their volatility is still high. Management we talked about. And the beautiful thing also is because you know, when I started trading, there was only monthly expiration, the third Friday of the month, and then, you know, quarterlies. And then they started weekly expirations. And now on the spiders, the Qs and IWM, they have 0 DTE options. So that gives us more trading opportunity every single day. And I've been hearing for 2 years now that they were trying to come out with, you know, a pilot program, 10 or 20 stocks of the FANGs and, you know, some other normal good volume ones, that they were going to do 0 DTEs, and I can't wait till that happens. Now, a benefit of trading the big contract options on the SPX, NDX, is that you can get further away and still get a good credit because it's a levered instrument. And two other benefits. You get favorable tax advantage on trading that. And thirdly, the value expires at 4 p.m. So after 4 p.m., if they are out of the money, you have zero assignment risk. Can't happen. Whereas if you were trading Apple and you're like, oh, great, it's expired at 4 p.m. out of the money, there's still circumstances where you can get assigned if the stock moves and the option holder puts in a manual exercise or request within the deadline to the broker. So this is just showing you why you win 2 out of 3 times. So here's just an example of a put spread. All these times it's coming down, I have a nice gap reversal. I'm selling a put under support. If you buy a further out of the money put, that's called a bull put debit spread. I'm sorry, bull put credit spread, and the net credit is your potential maximum gain. You profit 2 out of 3 directions when you're selling a put spread because it can go against you. And as long as it stays above my break even, then I keep the money, or I make money rather. If it stays above the short strike, I make my full profit. Same with the call sign. This is just a different way of showing what I just went over. So pattern people, we're looking for, every one of these are bullish patterns. Now it's the same approach I do in selling options 10 days or less, but these are going to be patterns 0 days or less. If I just do it naked, I'm selling a naked put and I keep the money, which I do all the time on 0 DTE because I don't have overnight gap risk and I don't care about the buying power. But if you don't have the buying power and you just want, to have less loss if the thing rips, against you, you can just do it like this. And you take the money in, and that's your potential max gain. Let's look at a bunch of examples now. 0 DTE. So this was some type of FANG stock. Here's my daily chart, and I'm always making my 0 DTE determination based on intraday go, no go decision. So yeah, this was Meta a while back. So big run up to major resistance. It gapped down in the morning. See that? It gapped down. 15-minute chart, and these vertical lines here are pre-market. So the day before, you can see how much this thing ran. And then it's kind of an M top, but it still closed bullish. Look where it opened here, pre-market. It opened under all of this support. Because of this momentum move up, it has little support to halt a move lower. So whether I'm staring at I'm really staring at a 5-minute chart, but I'm showing most of these on 15 just to show you more data. So it looked like it went up and got immediately rejected. So under a 5, 10, 15-minute low, the key is whenever you feel confident. Now, confident doesn't mean it's a guaranteed trade, obviously. We have a stop loss. And of course, we stop out of things. But when this takes out a 5 or 15-minute low, you ask yourself, where am I comfortable that this is not going to retrace by 4 p.m.? So we went to the option table. We say, look, yesterday's high, 540, 540. We sold a $10 wide bear call credit spread just because doing a 540 on expensive stocks going naked is going to eat a lot of buying power. Same with the SPX. We always do spreads. but I go as far out as is necessary, only to pay a penny for the long option. So I'm getting the benefit of much less buying power for the cost of a penny. We manage in between as it's falling down. We closed half at 20 cents for over 50% of max profit in 1 hour. Just put a bid out for 2 cents for the rest. I always close these just to have zero assignment risk. And I'll just, I have hundreds of examples that I could show you, but I don't need to. We'll get through as many as we can here. This was when GME was making crazy moves. So on this particular day, it gapped down, went up, got slammed back down again. So let's see what's going on the intraday time frame. Closed at the high right there. Well, this actually shows it opening flat. So yeah, maybe I don't know. Maybe that tail isn't right. So it immediately got sold. Came here, started selling off again. As I said before, when things have high volatility, you can get so far away and get paid even for a couple hours. Some people who don't understand this strategy, they say, oh, well, Dan doesn't know what he's talking about because you aren't going to, there's no premium on zero DTE. It's 100% an accurate statement. Market makers they make markets. They're always providing a bid and an offer. We just got to make sure it has adequate premium for the strike, for the pattern. So look at this. We put this on, let's just say when it was $40. Came down hard here. So we went $45 higher. Somebody was buying, a lottery ticket saying, oh, well, I think this thing's going to rip to 100 by the end of the day. So they buy a call for 70 cents a share. And I say, that ain't going to $85 today. It might in a day, 2, 3, 4, but not today. It's surely not. And then we put our stop in and we closed it at a penny. SPY. This is what we call, so this is just a 15-minute chart. So this was a nasty, nasty afternoon sell-off on this day. Pre-market, so it gapped up pre-market, formed a higher low. This is market open, went sideways for an hour. Holding the pre-market low, holding the prior day's low. Once it traded over this 1 hour bars high, just went to our checklist. With the checklist, it's the same thing over and over again. Pattern, liquid options. Tell me what you're going to pay me for the strike, for how long of expiration. On this one, here's 513. So the prior day's low was 513. We went $1 less than that. Stop at the day's low, mind you. Moved up. We huge choice, stabilized, closed half at 12 cents, bid 2 cents. We're done. We're out of this trade at lunchtime. Here's an example just showing you. Let's say this is a kind of a dead animal bottoming pattern, so I have no interest in buying this stock. So you see, though, that selling options is a totally different mindset. So right over the high of this green bar, so it actually triggered and immediately went against us. But I did the math here for you. So from where we sold a $9.50 put, which was under all this support, the stock could fall 12.6%, and we still make our full $300 profit on a 10 lot because we took in 30 cents a share. And if you don't mind owning the stock, you could take assignment at 9.5 because remember, when we sell a put, we are taking in money, premium, and we have an obligation to buy the underlying at $9.50 on or before expiration. This thing went against us. So this one actually I shouldn't have even put in here, and the reason is because this was not a 0 DTE, but it shows you how the stock can go against you here. Same on daily, and you still make money. So there was another one. Yeah, I got a lot of examples here. So this was another FANG stock pre-market. Nasty gap under a green bar. Look at all this major resistance. So you've done your job, daily chart. Let me now go see what the 15-minute chart or 5-minute chart looks like. Momentum move, close down here, ugly gap, rallied, slam back down, couldn't bounce, started to roll over during the lunch period. So look, I purposely said lunch period. Why did I say lunch period? It's because it's probably 1 o'clock Eastern time, which means there's 3 hours to go till 4 p.m. NYSE close. This one we sold a $20 wide, got $1.85 a share. Folks, look at 1720. That's all the way past this gap fill. Look at it on the daily chart also. So think about this. Now, I seriously doubt people aren't going to be selling a 10 lot on this, but let's just call it a 1 lot, okay? Let's keep it small. So you sell 1 contract of this bear call credit spread. As long as it closes below 1720, you make $185 per contract. Just let that sink in. That's the benefit of selling credit spreads with the charts. Now, could it happen? Could news have occurred in this rip to 17 to 1800? Of course it could, but then we'd stop out. And so if I started a seminar and title it, I'm going to show you how you can make money even if the stock goes 12% against you, I probably would just delete it thinking it's spam. It's like, who are you trying to fool? When you trade stocks and options, or stocks and ETFs and futures directionally, you only make money if it goes 1 penny or 1 tick in your direction. This is a different game. This literally came from one of our subscribers, and we love hearing this. I made money and the stock went against me. This is what we call a wide range ending bar. 15-minute chart, rinse and repeat, pre-market going sideways. Market open at 9:30 a.m. It got shellacked. We sold an out of the money bear call credit spread for that. I mean, you can just read some of this real quick, but there's so many fallacies, incredibly risky. Well, but those few charts that I just showed you, I don't know how it's incredibly risky. I'm taking in money for making a technical bet that it's not going to go somewhere in a couple hours, and I have a stop loss. The risk to reward, and this one, people just don't understand, and so I don't fault them other than just not getting education. When they say, "Hey Dan, you said you took in $1.85 on a 20 wide, so you're risking $18.15 to make $1.85. Is that correct, Dan? Yes, that is a correct statement. And they'll say, well, that's ridiculous. You know nothing about risk management. And I come back and say, well, you don't understand many things. Number one is, what was the probability of that stock getting to the short strike? So probability. And number two, Apple Computer's trading at 236 right now. That's like saying that I'm risking $236 because that's my max loss if I buy stock, right? Isn't your max loss what you pay for it? But let's hypothetically say I have a $4 stop on Apple. I don't go around saying I'm risking $236 to make $5. I'm risking what my stop loss is to make my perceived gain. See the difference there? Just showing you this. This is the S&P over a couple days, and we're just looking for major turns. So every one of these green spots here is a good turn. These are just here, bullish retest, but this is good. The small little M-top breakdown. These are where you want to start paying attention to go through your checklist and say, aha, look at this double bottom here. How much can I get for selling the 272s or 271s or 270s? You know, the farther away you can get from danger and still getting good premium is what we want to do. This was our weekly options that I mentioned to you. All we do is sell credit spreads. You get 5 to 15 trade ideas per week. We send trade alerts during the market in Telegram, so wherever you are all over the world, check it out, mastertrader.com/weekly options. Climo, gap down. This one had huge volatility also, but this is a picture of the quote screen. Also, the AMC. So this was an older chart. So this is the time that AMC and GME were the toys for those Reddit boys causing a short squeeze. So this is part of my checklist. Okay, I got a climactic sell set up. How much are you going to pay me to take on that risk? Look at this, folks. I just grabbed this 75 just to bring your eye to this. Now, this one's not a 0 DTE, but still, you see what I'm getting at here. So pretend this was 0 DTE, and of course, these are going to be smaller than they are now. But look, my stop loss would be over this tail. I have $5 more of cushion. This is the bid for these $75 calls. That's the ask. If I sold the 75 125 call spread, this was an actual trade alert. I said under the low, so it didn't trigger yet. So I was saying under this day's low, we're going to sell this credit spread, stop 73, and manage in between. We do this every single day in our live trading room. This is we have a no-brainer $7 trial for an entire week. This is where you come in, watch my partner, Greg Capper, and me walk the talk. Everything we do in our webinars, we're doing in real time. So it's not woulda, coulda, shoulda. It's do it right now instead of showing you this beautiful chart. And every one of these Telegram alerts are real trades. So this was in our weekly options trader. New low reversal on the gap up. So what would I do on this gap up? I'll tell you what I'm doing. Going through my checklist, seeing what the premium is. This was a 0 DTE 99. We shorted the SEP 99s. And at the opening price, it's gapping here to resistance, but it's a bullish gap. It's down a lot from here. New low reversal. I'm telling the folks in the green room and our Telegram customers, if this takes out a 15-minute high, which is over the high of this 15-minute bar, selling out of the money put spread. We're going to do the 334. How did I get 326? That's weird. How did I get an $8 wide on this one? I'll tell you why. I only paid a penny for the 326s. We went over that. So you can either do the 334s naked, or just for peace of mind and less buying power requirement, spend a penny. We sold this one for 52 cents, closed half at 14, bid 2, and we're out. We got, we're out of it in this morning rally. Now, when the market sells off a lot, like the spiders had multi-day declines, this is the volatility ETF, VXX, one of the many. There's levered ones. You could do options on the VIX. There's options on VIX futures. There's a lot of avenues to trade volatility. So, and I have a whole 4.5-hour specialty course on trading volatility products. And again, it's based on the chart. But look at this daily chart of volatility. You know what this is telling me? That this was a mini market crash. This was another little crash. This is another bearish. So this is a very bearish time in the market. But now we have a gap to resistance, took out the 30-minute low, and I guarantee you, because it's what I teach, that the spiders were kind of the flip, in the sense of the spiders were probably a big old double bottom, taking out a 30-minute high. So many times when I recommend to subscribers, hey, go ahead, sell your put spread like this, sell your put spread on this gap up. I'm looking to see what the premiums are on the VXX, because look, it's right here. I said 30-minute low. We're going to short the 55.60 0 DTE call spread. Right there again. Same, just is another example. Oh, so this is SPX. Here, let me show you this guy. This is his name is Dr. Paul Inkelis, and he's been in our green room with us for years. This is his home environment, and he loves selling 0 DTE on the big contract, the SPX. And so I nicknamed him McGraw after that. I think it was the cartoon. Yeah, the cartoon guy, Quick Draw McGraw, because whenever I'm in the room and he can just hear my tonalities, my tonality is something like, oh, that looks good. And then he's like, boom, he's in it already. But he's very aggressive and successful. So here's 15-minute, gapped up, came down, pulled back to support, 2-minute chart broke out. So on this one, this is sloppier than those other examples, right? But I'm not selling at 27.90, because this could very easily kind of sputter around, make a new low and reverse. We went way down here and sold it under the prior day's low. And I typically do 20 to 30 wide if I do the SPX, but this thing, this is a race car because it's levered, and so I do not recommend this for new people. The SPY moves slower, but we did this one, $1.10 a share. It rallied again, same management, closed half at 30, half at 10. But look at it, look at this cat's success. I've had much higher percentage since joining you all. Look, this old dog has learned new tricks. There's my buddy McGraw. And yeah, this is an old chart also, but look, 89 of 92. he's successful, 97%. And you know, if somebody tells me all of every, you know, 100%, if anybody tells you 100% winning rate, I just hang up on them, because that's just not realistic. So look, he's showing you his losses. That was a big hit, $7,500, but net he's up 91 grand. All right, we're at the end of our time. This is our beautiful special that my partner Greg put together for you. So in the intro, I was talking about directional option strategies. Oh, you know what? I didn't finish the 3 benefits. I didn't finish them. So you have the benefit of leverage. So we're controlling and getting paid for our bias with much less capital outlay. And because of that, we have less maximum loss. The third benefit, which I don't hear anybody talking about, but the way we trade directionals, not every time, but many times, the majority of the times, if we stop out, we have lost less money than if you were trading just the underlying only. Why? Quick answer is because there's still time decay left on the long option. And then these, both advanced credit spreads and mastering, they're just levels of complexity. This is a fabulous 5-module course. This is a very detailed 12-module course, and any aspect that you can think. Use this code mastertrader.com/Valentine options, because Friday is Valentine's Day. 30% off either one of these. So I appreciate being here. I hope you learned a lot. Feel free to email me, Dan@mastertrader.com, with any questions, and have a great afternoon.